It is almost 11 a.m. in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda, Amin. Here are the top stories. Asian stocks fall as traders await the Fed's rate decision, with the jury still out on whether it will be a 25 or 50 basis point cut. Hong Kong's struggling stock market sees a glimmer of hope from MyDear's strong debut. The city's biggest listing in 3 years revived hopes of a turnaround. And India saw its biggest ever debut for a big IPO, with Bajaj Housing's shares more than doubling. We speak to the firm's chairman, Sanjeev Bajaj, on the listing and the outlook for India's economy. It is good to be back after 2.5 months on a week that is so huge. Traders pretty much focus on the Fed. It is seen as a pivotal moment. And of course, we're seeing shares down. Avril, trepidation in the market.
Yeah, we're seeing traders kind of bracing for what we're going to get from the Federal Reserve this week. And indeed, that trepidation being reflected in the Japanese equities. The Nikkei entering the lunch break with declines of about 2% as traders come back to adjust to what we're seeing in the yen strength. Remember, markets in Japan were shut just a day ago. We have South Korea, we have Taiwan. They are still closed today. And amid all this, it is really interesting to see even the Hang Seng is managing to gain some ground. Now, the debate really goes about whether it's going to be 25 or 50 from the Fed this week. And indeed, as the markets are split, and as we saw earlier in the week, and indeed late last week, how traders ramped up their bets of 50 basis points, we saw a softer dollar. Bloomberg Dollar Index at its lowest level since roughly January. And this has really helped Asian currencies. Take a look at some of the FX like the rupiah and, of course, the Japanese yen as well, which just a day ago broke through the key psychological 140 level. Of course, this was on a day where there was thin market liquidity, so that might have exacerbated some of the moves. But I also wanted to flag that amid this dollar softness, there are risks to this view. If we get a 25 basis point cut and the Fed disappoints, or if U.S. retail sales data comes in strong, we could see perhaps a petering out or unwinding of some of the moves that we're seeing in the FX space. The one currency that could gain in spite of what the Fed does, regardless of what the Fed does, might be the Japanese currency. Has.
Well, that's right, and it's seen quite a run up, 5% in the last 1 month alone. Here's a closer look at the yen's recent rally against the dollar as we bring in Joey Chu, head of Asia FX Research at HSBC. She has slightly lowered her dollar-yen forecast to 142 for the year end. Even at 142, it ain't too shabby. I mean, the yen has been going gangbusters, and we're breaching 140, as we said earlier. So beware wild swings, because we've seen such a run-up for the currency.
Absolutely. I mean, it wasn't so long ago that people were saying, 160, maybe even 170, isn't it? But, the thing about the yen was that the positioning was so large, short yen going earlier. And now the funny thing is that it's actually flipped long yen, actually quite long yen, probably the most long yen since maybe 2017. So I think that is also posing a risk going into the Fed meeting.
Further upside, right? I mean, we heard from Avril saying that even if the BOJ were to stand pat, all it has to do is sound a hawkish tone and the yen will go higher from here.
No, frankly speaking, our view is actually that the yen is more like a reactor to market events in the coming months, because our house view is that the BOJ's next move is actually only in January next year. So we think that it's going to react to market events like the Fed or even US election rather than be an originator of market volatility.
We're talking about Asian currencies. Just to break here, as it crosses the Bloomberg terminal, Thailand planning to raise borrowing by 8% to 2.59 trillion baht in financial year 2025. Not surprising, of course. This is one country that needs a boost in terms of its economy, and also there have been big spending plans by the government as well. A new prime minister in place, perhaps trying to drive that growth. I'm just wondering your thoughts on the Thai baht at this stage.
Look, the Thai baht has outperformed so much, right? I mean, some of it is justified because, of the dissipation of some political uncertainty earlier. And we also know that it has this really strong correlation correlation with gold prices, which keeps hitting new highs almost every day. So I think some of this is, in some sense, justified and fundamental. But still, I think if you look at the Thai baht near, the nominal effective exchange rate has outperformed so much. I think some consolidation is actually quite likely.
Well, consolidation, not just in the Thai baht, perhaps, right? Other Asian currencies might be due for some correction. They've been partying with dollar
Absolutely.
easing, but a correction, possibly.
Yeah, exactly, especially if we do get, a 25 basis points, or let's say we get a 50 basis points, but the Fed sounds quite more, like signals a more gradual pace going forward. So like, a large opening, but a more gradual pace going forward. I think that could also cause a bit of a rebound in the dollar because, the positioning right now, not just in yen, not just in Asian currencies, but also in the dollar itself seems a bit, stretched.
Before we talk about the dollar, and of course, what's important, the move by the Fed, some Asian currencies have gone gangbusters as well. The likes of the ringgit, of course, the rupiah as well, Bank of Indonesia, possibly likely to cut. I mean, clear indication when the Fed is cutting, and even prior to that, Bank of Indonesia has said it was ready to cut.
It is
the time
true.
is now.
Yeah. So our economist actually has a non-consensus call that they would go for a 25 basis points. I mean, I guess the logic is that the Fed has been so clear that it's going to cut. It's just a matter of magnitude. So they might as well just do it 12 hours before. Now, our view about ASEAN currencies is exactly as you say. They have gone, outperformed so much, right? So I think in some sense, they have outperformed North Asia a lot, not just because of this, Fed view, the sensitivity to US rates, but also because maybe they have slightly less upside risk, dollar upside risk when it comes to US election.
Okay, let's get back to front and center the Fed, 25 or 50. Right. Why not 50?
Right. So I think the real reason, there are two reasons. One is that, inflation, our economist actually still sees core PCE inflation hovering between 2.7 to 2.9% for the rest of the year, and only see it falling below 2.5% next year. So that's the first reason. The second reason is that if we look at growth indicators, actually the Atlanta Fed GDP tracking is still above 2%. So this is not an economy that needs a lot of insurance cuts right away.
But this is also a Fed that has been listening to the market. The market will be disappointed if it doesn't see 50. And of course, on the other hand, we saw the likes of Elizabeth Warren saying 75 is it.
Oh yeah, definitely. So look, I completely agree that there are all sorts of arguments that are very worthy on both sides. So it's really a coin toss. It's really a very, very close call at this stage.
How closely are you watching the movements of the dollar in relation to the Chinese yuan?
I mean, very closely, right? Because, we've been testing this 7.08, 7.09 type of support for some time. And there's been a lot of talk about how, Chinese exporters actually not been selling as much dollars for the last 18 months. So, now there's maybe a bit more push factors for them out of the dollar. I think our issue right now is that we're just not seeing that pull factor. The China's economic fundamentals, all this, over the weekend we saw it just keeps getting worse. So there are no pull factors per se, even if there's a bit more push factor. So I think we're just trying to, balance these two things to see really, what are the factors for the China.
As you said, Joey,
Yes.
I mean, the data we've seen out of China so far is yuan negative. Is there a reason for China to perhaps reduce its holdings further in treasuries to prop up its currency?
We actually have not really seen that much of that. But what we have seen is, this Chinese exporters sort of holding back in terms of selling dollars. And they've also been paying down their dollar debt. So they're trying to reduce their dollar liabilities. So we're trying to see, so we've been seeing all of this. And I think we're just trying to understand, where they go going forward.
We've been looking for a turnaround in the Chinese economy, and some say that with the latest data out of China, perhaps there is a greater impetus, urgency perhaps, to introduce more stimulus measures. Of course, China has refrained from doing that. Is this the stage where it does need to seriously consider to prop up its economy?
Yeah, definitely. So we believe that there's more urgency, especially after the recent spate of the data. So we are expecting more monetary easing, 50 basis points of RRR cut, 20 basis points of policy interest rate cuts, and of course more fiscal stimulus, maybe in the form of special CGB bonds.
So against this backdrop, if you were to hazard a guess on bets for the FX space, what are the best crosses that we should be looking at if you're taking a look at a 6 to 12 month period?
Right. I think, right now, if we plot, say, dollar ASEAN and dollar North Asia, I think it's quite clear that there is a divergence. There is a gap. Dollar North Asia is lagging dollar ASEAN and lagging the DXY index. So if there's going to be a catch-up, it is in these North Asian currencies, meaning to say RMB, Korean won, Taiwan dollar. And a lot of this is hinging, I think, on the US election risk as well. So maybe, we need to get through some of these risk events before we can really think about this catch-up trade.
Before we let you go, we didn't talk about the Indian rupee. I mean, this is a market that's been doing really well, and we just had a massive IPO yesterday. I mean, how do you view the currency?
Actually, the currency has been surprisingly stable. It's been stable during the bad times, it's been stable during the good times. It's been a very stable currency. And I think, we've observed quite a large increase in FX reserves. So I think that could contribute to a little bit of that. But I think mostly it's just that the flows are actually quite balanced. On one hand, you do see the portfolio inflows, but this is also an economy with a current account deficit.
We've gone round Asia in about 6 minutes. Joey, thank you. Joey Chu of HSBC. Well, still to come, Bajaj Housing Finance Chairman Sanjeev Bajaj joins us to discuss the firm's hot trading debut in India and what's next for the company. Keep it here with us. This is Bloomberg. Welcome back. And it was a massive debut for Bajaj Housing Finance in India's biggest IPO this year. Let's get to Manika Doshi with the details. Manika, a massive performance, 136% up. Of course, this is one stock that has, the big names backing it, the likes of Goldman, the likes of GIC in Singapore.
Well, absolutely, Haslinda. That's been a spectacular debut for Bajaj Housing Finance. Three big reasons why. It comes from excellent parentage, one of India's oldest industrial groups that has built out a market-leading financial services business over the last 2 decades. Then there is the unmet demand for housing in this country. It's a growing space. It's a country with one of the youngest demographics across the world. And thirdly, we've seen a flood of retail money come into the Indian equity markets over the last several years, and that is fueling demand for high-quality paper. Well, actually, in some cases, also low-quality paper. But this IPO has benefited from all three forces.
Well, great spark indeed. Let's bring in Sanjeev Bajaj, chairman at Bajaj Housing Finance, to discuss the company's outlook and that stellar IPO debut yesterday. Sanjeev, good to have you with us. Was it a surprise?
Good to be here. Well, we knew that this IPO would do well. What we didn't know was how well it would do. And as Manika said, this is a combination of pedigree, of performance across other companies in the group. It's also naturally a sign of the markets.
Sanjeev, it is a neat pile of cash that you're seeing right here. How soon do you think it'll be deployed?
Well, the sector as such has been growing 12-13%, given the requirement for housing for first-time buyers in the country and the promotion that the government is doing to encourage this as well. We see a 13 to 15% growth for this sector in the coming years. As Bajaj Housing, we've been growing faster than that in the past year. And given our own plans, we expect that to continue as well. So the capital that is there with us at this stage, we've diluted about 11%, should take us through for the next few years. And as per our own listing regulations, we have to dilute up to 25% in the next 3 years.
Well, that's going to continue to be an overhang on the stock, but that's when reality sets in, Sanjeev. You pointed out the growth potential for this market, but you're doing business predominantly in the 6-7 fastest growing states in India. So I'm curious to know, as you grow out, to smaller states, how do you sustain both that, growth rate, which is twice the industry growth rate, as well as your lower credit costs and your asset quality?
So, Manika, there are two different things. One, if you look at these 7 or 8 states, these currently account for most of the housing market, and our market share there varies in different states, but it's still very low. We're still a new entrant. We're only 7 years old. Of course, we have performed well. So we believe that there is enough opportunity in these 7 or 8 states as well. In addition, every year we'll keep growing. We'll add the next set of cities. Keep in mind that India is growing at 7.5%, which means that some of these states are growing at twice those rates, 2.5 times those rates. And every 3 years, there are a bunch of new towns that are coming up, where we see prospective customers. So I don't see growth to be a challenge at all. The second thing is that when you look at our own business, while housing could be one monoline, these are actually divided into sub-businesses. There are various income segments we cater to, from premium to non-premium. We work with developers for construction finance. We do corporate lease rental discounting. So we participate in every part of that chain. That makes it mutually dependable with the different players there, but also allows us to grow, but grow managing risk. Because we do see cycles in each of these different segments. It will allow us to keep our accelerator on where required, put the brakes where required. And finally, when it comes to credit quality, risk has always been at the forefront of us when we build business. It's a combination of our teams on the ground. It's also a combination of how we leverage data and technology. We have to make more informed discussions on our borrowers' ability to pay.
All right, Sanjeev, we're also going into, I don't know when, but we are going into a lower interest rate scenario that's always helpful to the lending business. But does that in some ways equalize the playing field? You've had access to cheaper, high quality funding, and now some of your competitors, as we move into a lower rate scenario, will also have that?
Well, it's relative, right? So one, I must say that Bajaj Housing Finance enjoys the highest domestic ratings. And this is on its own back. This is without any guarantees from the parent. Of course, being part of the group does help, but I must say it's on their own performance and their own book. When rates start falling, what does happen is that these are all floating rate loans. And as a result, to customers, the rates will start falling. They'll be the same for the rest. It'll be then a question of how well you can negotiate on your borrowing side. And we believe that we are as strong, if not stronger than others there.
Sanjeev, you talk about opportunities, you also talk about risk. Government has come out to say that it is concerned about bad loans, credit card debt. When do you see an improvement in the quality of those assets? And, is there a need for more oversight from the government, you think?
So, Haslinda, credit to GDP in India ratio is at about 37%. This is compared to over 70% in the US, close to 80% in the UK. I'm not saying we need to go all the way there, but at a larger level, I don't see a significant risk. Yes, what can happen is certain smaller segments can see higher leverage, can see higher stress. And this is where, firstly, is the responsibility on lenders like ourselves to slow down. So, for example, in Bajaj Finance, which is the parent of Bajaj Housing Finance, last year, we saw for a certain segment in the unsecured lending space, our bounce levels go up slightly and we reduce exposure there. The central bank then came out with a set of requirements to cool down that market. And we believe that credit to those segments have come down significantly in the last few quarters on the back of the measures of the central bank. So these cycles will take place. And for a good quality lender, you have to be able to go through those cycles and come out even stronger. And that's why, as I said, that while we're growing profitably, we are here to build long-term businesses. And that's why we always treat ourselves as a risk-first company.
Put some numbers to that growth projection. Currently $42 billion in AUM in terms of growth in the next 2 to 3 years. What are we looking at?
So, we're still in a regulatory limited period with the information that we can share for Bajaj Housing, and it has to be from our RHP. So most of these numbers are of the last few years, where we've grown just under 30% at over twice the market.
But you expect to do better? I'm just looking at, for instance, your performance in the last quarter, loan losses in last quarter, which ended June. You set aside 70% potential defaults, profit after tax at 14%. Can you improve on these numbers going forward?
Well, we have a next quarter coming soon in the next month, so we will know that. I cannot make a forward-looking statement at this point of time.
What are the biggest challenges for you?
For us, the challenge will be very clearly to expand in the coming years in a sensible manner. Second, it's a very competitive market. At this point of time, all the large banks, other than the other housing finance companies, see this as one of the lowest risk segments to lend to. And we have to keep in mind that corporate lending for banks has been soft in the last 4 or 5 years. Hence, they are greater focus on the retail side. I think as India continues to grow in the coming years, corporate lending is restarting. So hopefully there'll be a little lesser margin pressure there. Other than that, we are here to build businesses for the next 50, 100 years. As long as we stay focused on the ground, we take cues on risk as well as opportunities, I think we'll be fine.
Sanjeev, I have a quick question on your real estate outlook. And the reason I ask this is because about 60% of your assets under management are home loans, but you have, and that's a little bit lower than, what your peers have. So you do have a far more diversified loan basket within this one space, if I can put it that way. So what's your take on the real estate pricing side and what impact that could likely have on the proportion of your developer loans in the years to come?
One important factor, Manika, is in the last year or two, for the first time in almost a decade, we have seen the total inventory of vacant homes come down. And that's a good sign because this is a starting of another cycle of construction and lending to this sector for the coming years. Second, overall, if you look at home prices outside of Mumbai and Delhi, which are two very large metropolises, these have been reasonably steady and growing at a steady pace, which is also good even from an investor point of view. Our own exposure in developers is to a set of about 250, 300 developers who are mid-size, good quality, take one project at a time, have manageable debt levels. And the way we access them differently from others is a lot of the work that we do upfront so that when they have a project in place, we are ready to lend to them at that time. Our speed of completing paperwork is much faster. Our ability to lend to the house owners that are going to come to their project ends up being much quicker. Our entire process of applying and getting sanctioned for a home loan is end-to-end digital. There are, of course, some elements in that have to be physical then, but the rest is all digital. Our assessment of customer risk, what is a loan size that we can give to them? Today, we work across our group with over 100, 150 million customers. And keeping in mind the right data privacy norms, we are able to access them for various products.
Sanjeev, massive wealth is being created in India. How are you looking at wealth creation in the country and how you can tap it either through your products or your teams?
India is currently at about $2,700, $2,800 per capita, which means there are segments at $4,000, $10,000, $15,000, $20,000 per capita as well. Because we are, after all, a country of 1.4 billion plus people. So we end up segmenting each of these income segments, and we have about 13 of them across our various businesses. And we create not only products, but we create the entire customer experience, a combination of physical and digital, addressing different customer segments differently. And to ensure that the entire experience of buying and servicing a financial product from us ends up being as seamless, as frictionless as possible. We are very enthused with the Indian economy growing at 7% plus. We think in the next couple of years, we have a chance, if we get our things right, to grow at 8% plus. And what this means is that we are gradually changing from a nation of savers to a nation of investors. And this means investors will want better, smarter, easier to invest in financial products. I believe we are at the start of a very long positive cycle for financial services in India.
So Sanjeev, a resilient Indian economy, you're talking about 7% growth. What do you see the RBI doing then? Some say perhaps, you know what, a move in October, others say no move at all for the rest of the year.
I wish I had a crystal ball there. But as we heard statements, Haslinda, from the RBI governor recently, he's made it very clear that RBI's policy and that of the Monetary Policy Committee will be driven by what they see on the ground. Of course, they understand and they are exposed to what happens around the world. But I think I saw a little bit of a de-linkage there between what's likely to happen with the Fed. So yes, so the balls are a little up in the air, but we will know soon.
Very smooth in evading that question. Sanjeev, thank you. Sanjeev Bajaj, Chairman at Bajaj Housing Finance, coming to you live right here on Bloomberg. Well, plenty more ahead. Keep it here with us. This is Bloomberg.
Congratulations on the listing of my dear group of HKEX.
There you have it, the opening gong ceremony in Hong Kong earlier today as Midea made its trading debut. Of course, this is a Chinese appliance giant. It sells everything from air conditioners, washing machines, elevators, as well as other products. Its debut after raising $4 billion. Its IPO seen strong demand. It is an upsized listing at about $4 billion, the biggest IPO in about 3 years in Hong Kong. That stock now trading up by more than 8% as we speak. It's priced its Hong Kong shares at the top end of the marketed range at 54.80 Hong Kong dollars. Well, staying with Hong Kong, Tencent's co-founder Pony Ma has reclaimed the title of China's richest person as the firm rides a gaming resurgence in China. Let's bring in our China correspondent Min Lo. Min, take us through the rankings.
Yeah, hey Has, great to chat with you again. Well, I guess it speaks to the volatility of the Chinese stock market that you had 3 people take the top spot within just nearly as many months, because last month you had Colin Huang. This is the yellow line over here. He was up at the top spot for a mere 18 days before he surprised investors with his extremely gloomy outlook of the economy and his company's performance, and that wiped out billions of his net worth. So he slipped down the rankings, and then Zhong Shanshan, that's a white line over here, overtook as the richest man. He is the founder of Nongfu Springs, which is the water and beverage company. But in August, we had that very weak macroeconomic data, and the consumer staples sector as a whole has been performing very weak. It's the second weakest performing sector in China after real estate. So now he's slipping down the rankings, and you have the red line taking over. That's Pony Ma taking the top spot once again, riding on the resurgence of the gaming sector, because you have the likes of Black Myth, Wukong, and DNF really propelling the company to outperform some of its peers. In second spot is Yiming Zhang, who is the founder of TikTok-owned ByteDance. He is tied with Zhong Shanshan in the second spot for now. Let's flip the chart. You can see the performance of Tencent really rising up here. And this comes after Beijing actually spent the better part of 2 years cracking down on the tech sector and its billionaire tycoons, including Alibaba and Didi. Tencent wasn't spared either. They had to revamp some of their financial business and downsize and sell off its stakes, some of its stakes in the e-commerce and gaming sector. But as of the end of 2022, we started to see Beijing giving some signals that it is relenting on this crackdown, perhaps needing the private sector to do its part to help revive the economy. So there you go, Tencent, Pony Ma back at the top spot, but now 40% poorer than he was back at his height in January 2021. He was the richest man back in June 2020, but his wealth was later eroded because of the crackdown into the video gaming sector targeted at children. So we have to see how long he can hang on to the spot.
Well, poorer. It's all relative, and we know that wealth in China under great scrutiny there. Bloomberg's China correspondent Min Lo. 11:32 here in Singapore, and of course Japan has come back to the market under pressure from a surging yen. Avril Hong, take us through the latest.
Yeah, Has. Japan markets are back from the lunch break, but they're also back from a holiday just a day ago. And this is traders' first chance today to react to the yen strength. So certainly we're still seeing these export-related names, including the chip stocks, that are grappling with the surge in the Japanese yen. But what is helping to cap declines on the Nikkei, that is off by about 2% today, are the domestic demand-oriented stocks like your retail names such as Aeon. Now, it's interesting, the moves we've been seeing in dollar yen today has been fluctuating between 141.2 to 140.3 and is not quite range bound. There is volatility. Flip the board. I wanted to talk you through what we're seeing on 1 week implied volatility as well in the options market, because that gives you a sense of what traders are bracing for from the Fed and the BOJ this week. Indeed, it is the highest level since August, that August market rout. If you exclude that, it's the highest for the year. So you can see here the wild price swings. It makes you wonder the extent in which this is going to be a concern for some of these Japanese officials. And of course, as markets weigh the size of the rate cut we're going to get from the Federal Reserve as it kicks off its easing cycle, we had the likes of former Fed official Bill Dudley lending his weight to the 50 basis point camp. Take a listen.
The market has come to the view that 50 basis points at this meeting is in fact appropriate. It's pretty important that the Fed head back to neutral expeditiously, and that 25 basis points wasn't fast enough.
Now, we have one data point that is coming in just before the Fed decision, and that is the U.S. retail sales. So we could see that data actually having a bigger than usual impact on Fed pricing. The focus is going to be on the control group, as it gives you an indication of discretionary spending. The consensus is for a 0.3% on-month climb. If we get another strong number, you wonder how markets are going to take this. Against that backdrop, we're still seeing that softer dollar as traders, as you know, Haas, have been ramping up their bets of 50 basis points.
Yeah, but it's still a Fed that's data dependent. We'll wait and see. Avril Hong, thank you. Now, Barclays says any efforts by a second Donald Trump administration to intentionally weaken the dollar will face tall hurdles. Trump earlier told Bloomberg Business Week that a strong dollar was a tremendous burden. The bank strategists say capturing the Fed and intervening unilaterally are too costly to be plausible. They say fiscal tightening may be the first best way, but a politically unpopular option. Separately, Barclays sees Trump's proposed 10% universal tariffs supporting the greenback by as much as 3 to 4%. Well, let's get to a senior Washington correspondent, Saleha Mohsin. She joins us now to make sense of the presidential candidate's economic agenda. 50 days to go. Can we actually make sense? Are we even clear on their policies?
That's the question to ask, Haslinda. We are not clear on either candidate's policies. We know a little bit more about Donald Trump's because he has been president before, and he's been campaigning since January, maybe even earlier. Kamala Harris, on the other hand, does want to break from some of Biden's policies. She was not president, she was vice president in this administration. And we've heard she's had a truncated amount of time to campaign so far. So we have not heard a lot. So investors and market strategists, they're all making their bets on very little information. I think we're going to see more, hopefully more information come out and some opportunities to make adjustments.
What's clear, though, is that we've heard Trump say tariffs over and over again. He says tariffs are phenomenal. When he implemented tariffs during his first term, there was no inflation.
Yeah, that's the story that I wrote a couple of days ago. It's on the terminal under my bio. It's about economic weaponry under a second Trump administration. He has been talking about how economic sanctions should be used judiciously. And that all has to do with how the Russia sanctions kind of triggered this big de-dollarization discussion that has started already. It started in 2015 and 16 under the Obama administration. It ramped up in the Trump administration. Both Republicans and Democrats all love sanctions. But Trump is saying, let's instead lean on tariffs. Let's leverage the U.S. consumer market rather than the dollar.
It does seem clear that when it comes to Harris, we could be surprised. If you take a look at Joe Biden, for instance, everybody thought that when he came to office, he would pull back on Trump's tariffs, yet he actually accelerated. Could a similar thing happen with Harris?
Absolutely. Right now, what we have are two presidential candidates who don't have a lot in common, but one thing that they do have in common is economic populism and protectionist economic agendas. Republicans and Democrats in Congress reflecting how American constituents feel, how the electorate feels, that is coming through in both of these presidential campaigns. They are both leaning on Buy America, boost the U.S. manufacturing sector, raise trade barriers, and that means tariffs. The Biden administration did not lift or reduce any tariffs on China. Their rhetoric is less bombastic than Trump's, which actually opens it up to some vagaries. Harris is expected to follow the same line.
And of course, those policies are also inflationary at a time when the Fed is grappling with inflation, refusing to go back to 2.
Absolutely. They are. The tariff cost gets passed on to the U.S. consumer. There's data and anecdotal evidence and data from the Trump term and the Biden term of what happened for U.S. consumers. But the interesting thing is that U.S. consumers have shown a little bit of an appetite or willingness to withstand inflation if it has to do with this broader foreign policy, economic policy, protectionist goal. If they feel like we're paying a little bit of a premium on the cost of certain goods, but it's going to help American manufacturers, we're willing to pay that price.
Are we surprised then that countries like those in Asia are making plans already? If we take a look at how some of them are doing business, they're actually transacting in local currencies. I mean, that is a way to perhaps negate the I guess the implications, the impact from the U.S.
Well, you've just brought us right back to the conversation and closed the loop on it, basically, Haslinda, that if Trump does lean on tariffs, because he doesn't want to lean on economic sanctions to protect the dollar, those tariffs could actually drive countries away from the dollar, because still there is a reason for other countries in Asia, across Europe, Global South, Africa, to reduce its exposure and be less beholden to the U.S. dollar and U.S. policymaking, which is becoming more and more uncertain.
Before we let you go, any impact on the market? How will they impact the market? Does it matter whether it's Harris or Trump? What would it mean for stocks? What would it mean for bonds?
So far, it looks like either candidate would drive stocks up. Trump more so, but maybe Harris is better for bonds. But again, we have a paucity of policy. We don't know exactly how things could shake out.
And of course, historically, it's always been a case where stocks rise regardless of who comes to power. Our senior Washington correspondent, Saleha Mohsin there. Saleha, of course, is the author of Paper Soldiers, How the Weaponization of the Dollar Changed the World Order. Of course, it is a changing world order, multipolar arrangement right now. The Chinese and Korean translations of her book will be released later this month. Well, still to come, Kotak Mahindra AMC joins us to discuss the outlook on Indian markets. Hear why they're not ruling out possibility of near-term volatility. That's next. Keep it here with us. This is Bloomberg.
We knew that this IPO would do well. What we didn't know was how well it would do. This is a combination of pedigree, of performance across other companies in the group. The Indian economy growing at 7% plus. We think in the next couple of years, we have a chance, if we get our things right, to grow at 8% plus. And what this means is that we are gradually changing from a nation of savers to a nation of investors. And this means investors will want better, smarter, easier to invest in financial products. I believe we are at the start of a very long positive cycle.
And that was Bajaj Housing Finance Chairman Sanjeev Bajaj speaking with us earlier. Its debut saw a surge of 136% and pre-market up an additional 6%. Welcome back to the show. Of course, here's a look at Indian markets ahead of the open. Pretty much in reversal to what we're seeing in Asia. We're seeing gains pretty much across the board. The Sensex pointing to a higher open by about 0.1%. Remember that India bustling with debuts, $7.8 billion raised in listings so far this year. We're keeping an eye on Bajaj, of course, after that trading debut. It is opening in about 1 minute. Well, for more, Shibani Kurin, Fund Manager and Head Equity Research at Kotak Mahindra AMC, joins us now. Shibani, good to have you with us. A surprise or not that, Bajaj managed to surge 136%.
Hi, good morning, and always a pleasure to be on your show. So when you look at Indian markets, the three factors that have been driving markets, which is macro stability, earnings, and flows, all three have been pretty much intact. Now, if you just take a step back and look at what happened in the first quarter earnings season, the numbers were pretty much in line with estimates. However, the estimates were somewhat muted. Now, for the full year FY25, the consensus earnings estimates for Nifty are still in the range of 12 to 15%, which means that the earnings trajectory from year on has to pick up, specifically coinciding with the festive season, which should bring about improvement in terms of demand. Now, for our markets have clearly outperformed over the last year and a half by a big margin. And therefore, there are a few near-term events, including what the Fed does, global GDP growth, and some amount of the geopolitical tensions, which we must keep a watch out for. And therefore, for the very near term, it is possible that the market sees some degree of volatility. But as long as earnings and macro remain stable, we don't expect to see any sharp drawdown.
Shibani, is this an indication of how future IPOs this year will perform? The bigger ones, are they going to be up for grabs? Will there be the same kind of appetite?
So as far as IPOs go, yes, there has been a lot of supply in the market, but a lot of that supply has been absorbed as well. One must keep a watch on in terms of, the IPOs and evaluate these IPOs specifically the way you do any company. Our belief is that so far, while the supply has been high, the flows have been strong as well, which has helped absorb some of the supply. Now, when you look at the IPOs, you can split it up into two parts. One is companies coming to raise and list for the first time. There has been some degree of promoter selling as well as private equity exits. So these private equity investors have been invested for a while, and therefore, with the life of their fund coming to a close, there has been exits. And there have been companies which have also raised fresh money. So it's a combination of all the three which has driven the kind of IPOs that we have seen in the market so far. The way we are approaching it has been clearly looking at companies where valuations and earnings fall into place, looking at high growth, high quality companies, but trading at reasonable valuations. And that approach applies even for IPOs that are likely to come through for the remainder of the year as well.
It does look like investors have moved sectors from the likes of infrastructure and defense to perhaps, things like healthcare. They see more value there. Do you see this trend persisting through the end of the year?
Yes, so even at our end, there has been some sectoral shifts in terms of the way we are approaching the markets. From a valuation earnings perspective, there are 2 or 3 sectors that stand out for us at this point in time. The first is the consumption space, both consumption in terms of staples, as well as the mass consumption or the discretionary consumption at the lower end. Now, post-COVID, we've seen that the story in terms of consumption was premiumization. But now we believe that at the margin, that seems to be turning the corner. Monsoons have been good. Government spending is back on track. And therefore, we do expect to see rural wages start to pick up, supporting consumption. The second sector where we believe that risk return and valuations are still favorable is the technology space. This is a segment which is clearly very closely linked to what's happening in North America in terms of discretionary demand and spends. And within the large cap tech space, we do believe that valuations are still reasonable, and we expect to see some improvement in terms of demand. Structurally, we continue to remain positive on the entire manufacturing infrastructure play. However, as you rightly mentioned, valuations in pockets have become expensive. And therefore, from an overall valuation perspective, segments such as consumer, tech, and even parts of large cap banking, these are segments that we are incrementally evaluating.
Shibani, clearly there is euphoria among investors, whether institutional or retail investors in India. We're looking at inflows amounting to $7.5 billion per month. Is that pace sustainable, do you think?
So I think as long as the flows that have been strong on the domestic side over the last couple of years, that flow continues. If you look at our systematic investment plan flows, which is the monthly flows that come into mutual funds, that number has remained steady, and in fact, it has moved up. At the margin, we are starting to see over the last couple of months some amount of revival in flows where foreign institutional investors are concerned. And remember, today, India's weight in the MSCI EM bucket has gone up considerably, and therefore even passive flows have started to come through in a bigger way. So as of now, flows continue to remain fairly strong. But as you rightly pointed out, markets have seen a great run, and therefore one must be cognizant of valuations to some extent. When we look at the valuation of Indian markets, we always believe that look at it in context of growth as well as return ratios. From a PEG perspective, Indian markets don't look as expensive as just the multiple suggests. But when you look at large, mid, and small caps, the risk return continues to be in favor of large caps, where valuations are in line with long-term averages at a slight premium. Mid and small caps are at a considerable premium to their long-term averages. And therefore, where mid caps and small caps are concerned, one has to be more stock specific. Look at companies which are still trading at reasonable valuations, where earnings is still fairly strong, as well as look at companies where quality is clearly in place, as well as companies where liquidity and free float continues to remain strong. And therefore, from the mid-cap space and the small-cap space, while growth is strong, one must be more stock-specific in their approach.
Shibani, as we speak, we are seeing Bajaj inching higher, its shares rising by the 10% daily limit. Is this surprising, and how much higher can it go?
Unfortunately, my compliance does not allow me to talk about specific stocks. However, as I said that, the entire space, one has to be cognizant of earnings and look at earnings vis-a-vis valuations. One way of looking at earnings and valuations is clearly the PEG ratio and in context with the return ratio of companies. And that is something that we are applying across our portfolio companies as well as sectors. And therefore, look at segments where risk return is still in your favor.
Shibani, great to have you with us. Shibani Kurin, Fund Manager and Head of Equity Research at Kotak Mahindra AMC. And as we speak, we're seeing Bajaj still surging ahead by the 10% daily limit. Of course, it surged 136% in its debut yesterday. Plenty more ahead. Keep it here with us. This is Bloomberg. Here are some of the top tech-related stories we're following. China has claimed a breakthrough in the development of its homegrown chip-making equipment. Officials are encouraging state-linked organizations use a new laser-based immersion lithography machine with an improved resolution. China's Industry Information and Tech Ministry did not specify the supplier. China's chip makers have been hit by U.S. sanctions designed to thwart Beijing's chip ambitions. Intel shares jump in late trading after the chipmaker announced a new partnership with Amazon's AWS. Intel and AWS will co-invest in a custom semiconductor for AI computing known as a fabric chip in a multi-year, multi-billion-dollar collaboration. Separately, Intel is also postponing new factories in Germany and Poland, but remains committed to its U.S. expansion. And Microsoft has unveiled a new $60 billion stock buyback program, matching its largest ever repurchase authorization. Microsoft says shareholders will also receive a quarterly dividend of 83 cents a share, compared with the current 75 cents from November. The share repurchase agreement replaces the buyback program announced in 2021. Let's do a check on markets. Of course, it is all about that anxiety ahead of the Fed, but take a look where we are in terms of property stocks in Hong Kong. They're all trending higher. Wharf Real Estate currently up by about 5%. Gains too for Henderson Land, Link REIT. Of course, expectations are for the Fed to cut rates. The question really is whether it's 25 or 50. It is a pivotal week for investors, the long-anticipated Fed easing cycle. And by the way, What's at stake is also the state of the U.S. economy. Traders pricing about 100 basis point cut by year end. This is how it's shaping up. S&P futures down about 1/10 of 1%. We're tracking bonds as well. Yields lower for 2 successive weeks. 2-year yields at the lowest level since September 2022. In terms of the US dollar, it is pretty steady, but when you speak to some of the guests that we've been having, they say expect the US dollar to be trending lower. This is how it's shaping up for the rest of the region. Stocks under pressure, or not in terms of the HSI, it is in the positive. That is it. From Bloomberg Markets Asia, Horizons Middle East and Africa is next. Do keep it here with us. This is Bloomberg.